Well, hello, everybody. Welcome to the first ever live webinar with myself and the lovely Lucy Barrett. Sorry, Lucy, apologies. I've spoken to you for years.
Good start.
How are you? Welcome.
Very good, thanks, Nick. How are you?
Very good, thank you. Really appreciate you joining me. Now, obviously, what's exciting is we're doing this for the first time in Wealth Labs, so bear with us a little bit in terms of there is no format. We're just going to chat. The idea is that we jump on these calls every month. Let's have a chat through interest rates, what's been happening in the mortgage markets, what bridge loans are looking like, development finance, HMO mortgages, buy-to-let mortgages. We're going to talk about all those sort of different things. And I want to get a gauge. It's for my benefit as well as everyone else's benefit out there that's in the community, to really just keep us informed about what's going on. Is there anything we should worry about that's coming up? What are we expecting from interest rates in the future? I know you don't have your crystal ball, but I'm going to fire all these questions at you, and we're going to have a little chat through. Just a quick slide, which I'm going to put up of yourself, Lucy, for everyone that hasn't met you before. Lucy is the managing director of one of the UK's leading finance brokerages, Aria Finance. She is extremely experienced at all types of lending. We've used Lucy in our development firm for many, many years. You are master brokers as well, so you have a lot of the smaller brokers will feed into you, if I'm not mistaken.
Yeah, that's right.
You've got a huge market reach. Do you want to just do, if you wouldn't mind, just your own introduction? Obviously, I've introduced you.
Yeah, absolutely. Yeah. So we work across the whole spectrum of property finance. So everything from a smaller part of our business is straightforward residential mortgages. We have a team of people that do those. But I suppose where we probably add the most value is in the specialist world. And that really starts with buy-to-let, commercial, moving on to bridging finance, development finance, so the more short-term markets. And really it's trying to help clients and introducers to find creative solutions to package something up to make it work. So a lot of people come to us and they don't necessarily know what it is they're looking for. They just know they want to buy something or refinance something, take some money out, whatever the case may be. And it's just a case of looking at a more holistic approach for them, and working across the different product streams that we offer and the different lender relationships that we have to structure something that works for them. So we've got 20 years experience of doing that. We've worked in the specialist markets a long time, and within the business we have lots of people in the different teams that bring unique skill sets. So very well versed for anything property related, and obviously Nick, you and I have worked on lots together for yourself and other customers as well, so you've seen quite a bit of what we do. Yeah,
very much so. We've used buy-to-let loans, HMO loans, plenty of land and development loans for the development side of the business, bridge loans, portfolio type loans, second charge loans, all sorts. You did a deal on my own house for me as well, so you can do residential loans as well. That's fairly vanilla stuff. And I think, yeah, you've made a good point there that finance is not as simple as people think. It's very, very complex. And one of the things I think is worth talking about is for less experienced investors and developers getting into bigger deals. Maybe they've done a couple of HMOs, they've done some buy-to-lets, then stepping into the world of development finance is actually a whole different ballgame, isn't it? Can you tell us a little bit about what the lenders look for when you're sort of maybe doing a 5,000 square foot office to residential scheme or a commercial conversion? What are the different things they start to look at in the person as well as the deal?
Yeah, so I think there's a common misconception that lenders underwrite companies and properties. Actually, what most lenders are looking at in the very first instance is who is it that stands behind all of that? What experience do they have? What capital do they have to put into the transaction? What wealth do they have behind them? Because actually that all is part of the credit worthiness assessment. So you can't look at it in isolation and just say, well, the scheme stacks up, because ultimately one of the biggest risks in development is the failure of the actual development itself, because the experience and the know-how isn't there in order to bring it all together. And you know better than anyone that you'll always face problems on a development scheme, however experienced you are. And obviously in your earlier days of developing, those problems probably took longer to resolve. They can become more expensive. And essentially what a lender wants to understand is this scheme going to overrun in either cost or time? Time often relates to cost anyway. And then actually is what's been budgeted for the scheme going to be enough to get them to complete? Because if they've allocated whatever the spend might be for the build costs, and then they suddenly come in 20% higher, if the customer doesn't have the money to put that in, the lender would have a choice then. They either step in, and unfortunately things start to go very wrong at that point, or they have to lend the customer more money, but sometimes it's a risk of throwing good money after bad. Therefore, that is something that lenders will all be very, very conscious of getting themselves into that scenario. So they start by just wanting to understand the CV of the developer. So what schemes have they completed? Is it similar in not just size, but complexity? So basements often is a bit of a red flag. If somebody's never completed a basement before, that often gets pulled up as something that requires a bit more experience. And obviously it doesn't mean that no one that's done a basement build can ever do a basement build, because they won't get funded. But if somebody's on their second development and then they're doing a large basement, that might be a red flag. However, if someone's built 10 schemes and they've all gone really well, then the lender would say, okay, well, it's slightly more complex, but clearly they've got good relationships, they've got good people working for them, and we're comfortable that they can navigate that. So it's not a binary answer, and that sometimes can confuse customers, because people often ask us questions in a very binary way, and they want the response to be just one response. They don't want grey areas, and I think that's something that we often have to try and educate people right at the beginning, that it's a conversation and it's understanding every nuance of a transaction, and not just trying to kind of fit everything into one box, which I think if you're coming more from the buy-to-let or straightforward investment mortgage world, I think people expect that that's how it works. But actually part of the experience of what we do is really getting under the skin of each transaction. Oh, you're on mute, Nick.
Sorry, I muted myself. I was coughing in the background. I've got a little bit of a cold. Yeah, it's interesting you say grey areas, because property is full of grey areas, you know, whether it's planning, whether it's, you know, the numbers on the GDV at the end, you know, there's always going to be a factor of what it's worth, depending on the timing of the market. When things are finished, it can sway quite dramatically at any stage. You know, the build is constant grey areas of, you know, you do God knows how many surveys before starting construction phase stuff, and then you get sent a few curveballs through most builds. Almost every involved in, there's been things that crop up that you couldn't possibly have foreseen, or you've done surveys that have tested certain areas and then it pops up in another area. So I think, you know, being a property developer and at Wealth Labs are obviously here to help people, help educate people. We're doing a bit more of finance slant today, but we're there to give lots of free and useful, helpful communities and courses to help people. There are some paid courses if you want to move up the chain and do some more advanced stuff, of course. But ultimately, we're trying to show people that there's a lot to know and understand, and those grey areas can be quite vast.
Yeah, and actually one of the benefits of when we've worked on things together where your clients haven't necessarily got the relevant experience is that you pull together the project team. So actually that gives lenders a lot of comfort when you bring in people that fill the gaps that are perhaps missing. At least then if you don't have the experience yourself, you can demonstrate that you've got the right people around you and how they're tied into the transaction, whether that be with the build contractor or whatever it may be, even down to solicitors. So
Yeah, absolutely. When we've mentored people or done joint ventures with people, we've been able to back up the finance and put in place management teams that get people going on their journey a lot quicker, get them the credibility and track record they need to jump into deals. So there's quite a lot to that side, actually. Just wanted to say, actually, to anyone that's watching, that's joined in, please do type any questions in the box. There is like a raise your hand feature for anyone that's watching this live. We'll be posting the pre-recordings on wealthlabs.co.uk afterwards. So you feel free to log on there and look at that in the future if you want to look back on any of the content. Or if you're watching this recorded, you obviously can't raise your hand. But yeah, ask some questions away and I'll try and chuck them in as we go. If not, if there's any at the end, then I will come to you towards the end. But yeah, feel free to get involved and chat. So how have you got on this year, Lucy, with the way the markets have been? It's been pretty crazy, hasn't it? We all thought, COVID's over, great, let's get back to doing business, let's make some money, there's some business to be done. And yet, lo and behold, we're into wars and hyperinflation and massive interest rate rises, well, massive, relatively massive to what we've been used to. How have you found it? Can you just talk us through a quick timeline of the last 12 months when the interest rates shot up and lenders kind of went back into their shells and panicked a bit, and to where we are to the current day? And then my next question will be focused on the future, really, how you see the future. But for now, how have you seen the last 12 months and how have you survived and helped your clients?
So the first 3 quarters of last year were relatively smooth, and actually the market was buoyant, property prices continued to rise, and in actual fact probably run away a little bit, which is obviously part of the issue, and it feeds into this inflationary issue that we've been having, that the market has been incredibly strong for a long time. It's been quite a long cycle, really, and although COVID did set things back, it was fairly short-lived. So it almost felt as if we had escaped what they call the 10-year cycle, which is usually when you start to see a softening in the economy, something happens, recession or otherwise. So it had been really strong, and the turning point was really around September, October, and it happened very, very quickly. So obviously you had the mini budget, which kicked it all off, and it was no secret that was what absolutely sent the market into turmoil. So I think nobody expected, we knew the problems and we knew what needed to be fixed. Obviously, inflation was an issue, and at some point interest rates were going to start creeping up, and nobody, I think, wasn't alive to that fact. The mini budget just sent the markets completely wild, because the speed in which the market was predicting the interest rates to counteract some of the measures that had been put through in the mini budget or announced for the mini budget had essentially created this very, very big disconnect in where the Bank of England base rate was and where swap rates are. And swap rates is the rates which basically drives your fixed mortgage costs. So lenders were unable to put their fixed rates out without the rates at which they essentially receive their money in. So whatever their funding arrangements are, their cost of borrowing was going up so quickly that by the time they actually put the rates out the door and marketed them, the rates had gone up so dramatically that they then had to reprice it. Otherwise, those loans would have been very quickly loss-making, and which actually led to a lot of problems in that lenders weren't honouring rates, whereas historically you reach certain milestones and touch points throughout the journey of an application, and your rate's booked in, it's fixed, and you don't have to worry that it won't be available unless the offer lapse, which is normally, you get a couple of weeks from the agreement in principle, and then a few months minimum from the actual date of formal offer. So that just completely went out the window, and it was really hard to navigate, because nothing that we were used to was the case anymore. So where we would be able to tell customers, no, don't worry, once we reach this point, that point, or this point, we're really comfortable that we can proceed through with this. And we were having to have really difficult conversations with customers, because we were quoting things, and then in some instances within hours, not days, that product had completely disappeared. So in order to not let customers down, we were trying to move things through really quickly. But as you know, it's not always as straightforward as making a decision within minutes. It's a big financial commitment. You're often talking about large sums of money, and people don't want to be rushed into making a decision. But then at the same time, when they call up 2 days later and the rate has gone up by 1% or 2%, then they're very upset. So it was a really, really difficult time, and the team at Aria worked all hours to try and get cases submitted and lock in rates where possible. Unfortunately, there's only so much we can do if the lender decides not to honour them. So that quarter was really, really unpleasant, and I think everyone was ready for the end of the year when it did hit, and we saw interest rates in the buy-to-let market double. So in some case more, and they've not really come too much further down since then. However, what we have seen is, as the swap rate market has settled a little bit throughout end of December and January, we've started to see lenders a bit more confident on rates to come back and put out some lower rates, albeit in the buy-to-let space, they still start with a 5, whereas it wasn't that long ago that you were getting rates at 1%, 1.5%, 2%, and that just doesn't exist anymore. But realistically, it was a false environment that we've lived in, because interest rates cannot stay that low forever. And we were really spoiled with cheap debt, and that obviously drove a lot of competition in the market, which has made it very expensive for people to participate, and at some point that needed to correct. So the end goal probably is right, but the journey was very haphazard, and unfortunately a lot of people have fallen foul of it because their debt might stand at 75% loan to value, for instance, on an investment scheme, and rents haven't risen at the same rate that interest rates have, and therefore the cover requirements that lender needs means that in some cases we can't actually refinance people to the level they need to refinance in order to repay that debt with a certain lender if it's coming to term. So it's fraught with different challenges, but I think we're starting to see it settle at least, so that we can just get our heads around what we're doing and how's best to do it, and see some new products emerge. But it's certainly been an interesting time.
I think any property investor just wants stability, because we can make money by adding value. We can develop out stuff, we can convert stuff, we can build stuff. Developers, but if the market's all over the place, you can't predict it. That's where the risk always comes in.
Well, you're committing, if you're making purchase commitments, you're spending money, you're spending time, you're making commitments to people, which obviously impacts your reputation. So you need to know that you've got the finance in the background, and it's sort of, there was a very long period of time that someone came to me and said, this is what I'm looking to finance. How can I do it? What does it look like? I could tell them what it looked like, and that would be true for probably months, but at the very least weeks. And I would be really confident that I would have enough options for them that they could go off, make their offers, make financial commitments. And all of a sudden that wasn't the case anymore. So it became very difficult for people to make those commitments. And therefore, what we saw in the last quarter, especially around kind of October, November time, is people were saying, I'm going to do nothing for now. We were having lots of conversations, the demand was there, but nobody really wanted to commit, because they felt like interest rates were probably going to come back down a little bit. And actually now, throughout January, what we've seen is people re-engaging and saying, well, it probably isn't going to change much from here, so let's get on with it and start moving something forward.
The bit that was particularly scary is when they were pulling deals they'd offered. Now, my understanding was always that a bank, whatever kind of lender we're talking about here, a bank or a lender, would go and fix that rate with, say, the central bank or wherever it's buying its currency from, in the swap markets, and they could fix that. So then they're, somewhere further up the chain is having to commit to the rate rather than the bank themselves. But that's not the case. Can you
Yeah, so I think to touch on it without going into huge levels of detail, I think the issue that a lot of lenders had, and I think it's made people relook at their funding arrangements, is that because we've been in such a low interest rate environment, it's never really been a problem. Well, certainly not in the last 5-10 years. So
No.
banks, I think, were not hedging as they should have been. So effectively what they should do is, when they've got X number of committed mortgages, they should be purchasing their hedging arrangements, and they should be fixing the cost of the borrowing that they anticipate to see go through. Obviously they'll all have their formulas for that, that if they make 100 offers, maybe 80 of them or 70 of them will complete.
Yeah.
And what they should be doing is making sure that they've hedged sufficiently to ensure that they protected themselves against that interest rate movement. And I think it's a massive learning curve for lenders, because a lot of them hadn't done that. And actually, on the flip side, it can be dangerous for lenders to do that, because if they fix in at, I'm just going to throw numbers out, they fix in at 5% and then that drops to 4%, they've already bought it at 5%. So then they have to try and pass that money on with a margin to still make the money. Whereas obviously if the market's dropped and then other lenders are selling rates much cheaper, no one's going to buy their rates because they've got more expensive. So then they're holding on to all this fixed money that actually no one wants to buy because it's too expensive. So it's quite a difficult formula, and that's actually what made it so problematic, Nick, that it was so volatile that lenders didn't really know how to actually make that work. And I think given our proximity to a lot of lenders and speaking with people that we've known for many years who I trust implicitly and I know have got good integrity, I did have a lot of sympathy with them, because it was very hard for them to know what to do to still support the customer, but not to risk losing lots of money that would obviously impact their business, the people working for their business, and perhaps customers moving forward. So it was, really uncharted waters for a while, I think.
And I think obviously this doesn't apply to all lenders, so don't sort of take this as a broad brush. I think probably there are a number of lenders out there that were greedy, and when you hedge something, you have to bet. It's almost betting against yourself in the other way versus the margin, isn't it? So they're then just making the margin. And actually, when it's been such a stable, easy market, they probably weren't bothering to hedge. So it was suddenly sort of gearing up a whole new hedging process, arguably. I mean, I might be wrong with this, but it's just my
I think some lessons have been learned for sure. I think some lessons have been learned, and I think that it's probably one of the biggest topics now, and lenders have all started to invest a lot more in their treasury functions to make sure that they don't make those same mistakes again. And look, hopefully we won't see something like we have seen just recently happen again in the in the medium long term. Even hopefully that was a one-off event where interest rates moved at such a rapid pace, but the reality is they are going one way, so interest rates are very likely to continue rising. I think the next announcement's next Thursday, if I remember rightly, and it is anticipated that there will be another rate rise at that point. So I think we can still see a little bit more of that pain coming, but again, as long as you can see it and as long as it happens in a slightly calmer manner, then I think people can deal with that. Look, interest rates are going to be higher than what we've seen for the last 10 years plus, and that's just the way it is. And people, as you made your point, will adapt. They'll change their business models. They'll find ways to make money. The problem that you have is because it happened in such a short period of time, that can't all get passed on. So if you look at it on the most basic form of investment, where you've just got a single let property with a buy-to-let tenant in there,
on a 12-month contract,
on a 12-month contract, or even if it's coming up to renewal, realistically, if your mortgage costs double, can you double your rent? can the tenant afford double rent, or actually does that then lead to arrears? There's a cost of living crisis as well, so obviously people's energy costs are through the roof.
There's always a lag, isn't there? So there's going to be that lag where the rents won't have gone up straight away, but the rents have, and you just got to gradually bring your rents in line, I think, over the next year or two. And you can't charge more than market rent. So if so and so next door's keeping his rates the same, you're going to be stuffed by his fact he's not got a mortgage. So how heavily you're leveraged is obviously critical. So
absolutely. And I think there's a few corrections to come. I mean, I don't personally see property prices falling in a really, really drastic way, but I think the market will stagnate for sure, because there is, especially at the moment, if you look at it, say, let's say you're a developer that's selling houses to end users, affordability is an issue because the cost of borrowing has gone up, and obviously that the period of time, although we've had a lot of wage inflation in recent times, it's not inflating anywhere near the rate that interest rates have risen. And then obviously the energy costs on top of that means that people's general affordability isn't as good, which means that they can't afford to pay some of the prices that we would have been seeing. So I think the market will really slow down, and everybody will find time to adapt and get used to a new normal. But I'm not doom and gloom on property prices, and maybe I'll stand to be corrected, but I don't see a marked drop. I think it will just steady for a while.
I feel like it's like another version of COVID, the market, in that everyone just stopped transacting. So there's massive lack of liquidity. And then anything that did sell wasn't selling. So you had to drop the price a little bit. The prices didn't drop overall that much because there wasn't that much on the market at a lower price. So because it sort of stood firm for quite a while, the prices, didn't go down too much. And then when that liquidity returned and the markets opened back up, there was a mini boom, which was, sort of a false boom really, at the end of 2021. And I think something similar might happen here. I think, like a few months ago, I thought, this could be quite doom and gloomy. It could be a couple of years of recession. It could drop by sort of 5, 10, maybe even 15% in some areas. But I think, again, it's micro areas, isn't it? You've got to focus.
It will be regional, for sure. You'll see that.
Good areas will probably go up, a little bit, just with all the inflation that's going on as well, of course, because ultimately inflation can positively affect property prices in the right economic setting. So it's as if the world is colliding here, that actually in a year or two, prices are set to rise quite a bit, and it might just stagnate now, and it'll be the not so desirable areas that maybe dip. So it's good.
I mean,
we agree on that.
Do you see? Have you seen in your world things start to come through, opportunities start to come through? Because that's always a good indicator, isn't it? If you're starting to see more opportunities, are there people out there that are willing to sell, or is everybody just holding tight to see what happens?
I mean, I'm focusing on developments and commercial conversions mainly. There are definitely more coming to the market. I think sellers are getting more realistic, that a vacant office in this market, we're not really talking house prices here, are we? Because as a developer, you're looking at land sites, or you're looking at redundant commercial buildings to convert. It is a different market to when we talk about house prices.
It is, but then at the end of the day, you're kind of working off of the house price at the end of it. And that drives your site price, doesn't it? So for you, I suppose you're going to be more cautious on what you pay, because you need to assume that if prices come off a little bit at the end of your development, you don't want to pay kind of today's GDVs, if you like, when you look at the residual value of the site.
When it could be 10% a year. And actually, it's being driven more actively, really, by the inflation of the building materials, the labour rates, and that kind of, and obviously the interest rates on the loans. If you're taking land and development loans, it's going to be more expensive. So actually, that's why, I think vendors of sites, development sites, commercial buildings are getting a bit more realistic, because they're seeing developers are getting squeezed. So if they want to sell the building, the developer's still going to make 20% minimum, ideally 25 or even 30% sort of return on cost. In an ideal world, they've got to reduce the prices for that. So I guess that's, that always lags behind the market anyway. And I think this year we'll just continue to see site owners that want to sell or having to sell softening. And of course, you've got the fallout of businesses going bust from COVID. That's hitting home now, isn't it? Lots of high street shops where there's you better enact Class MA, permitted development rights, converting some bits of rear. There's going to be loads of that coming where shops are struggling. So yeah, there's definitely been more stock dripping on the last 2 or 3 months than there has been the previous year and a half. So
which could actually be a great opportunity for people either in the market or looking to get into the market. Because actually, if you've got less competition, because some people are a bit nervous, it often drives opportunity. Yeah,
100%. I've got a question from Craig, which I'll come to in 1 second. Just wanted to say that we've got a quick free course in Wealth Labs. I think it's an introduction to specialist property finance. It's something that Lucy's worked with me on in the past. That's on there for free under the courses section. Go and look at that along with a few of the other courses. And also, if you want to book a call with one of Lucy's team, just drop me a message or drop Lucy a message on Wealth Labs. You can hit us up in the chat. You can pop something in here. You can ping us an email. I'm nicholas@wealthlabs.co.uk. Just reach out within the community somewhere, comment under the webinar. We'll see it, and we can hook you guys up for a chat, whether you've got a refinance or a buy-to-let, or you're looking for a bridge loan or a portfolio loan, or trying to pull some money out of your existing portfolio. Worth a call, worth a chat. And Lucy's always there as the member of our power team that we've used for many years now to do all of our lending. We wholeheartedly recommend her. I'm really excited and pleased that she's agreed to come on and do some work with us with Wealth Labs to help educate people and keep you guys posted in our small community, small but growing community. We've only launched it in the last month or so, soft launching. So it's all very exciting. And we'll be doing these every month, of course. So go into the events tab in Wealth Labs and you'll see the next couple of months with Lucy that we've booked. So go and book onto those if you're on this one. And we'll see you next month for that kind of installment as well. On to Craig Shepherd, who is my business partner. It's one of our JV partners with Gallant Developments. Go and check out Gallant Developments. We met on the Property Elevator series on Property TV. And I did a deal with Craig, and it's going fabulously. We've got planning in fact, Lucy's doing some finance for us. You'll be pleased to know. We've got planning going very shortly on a new build house next to an existing house that we're refurbing as part of a site. We've got an offer out on another site in Hampshire, which we're going to see tomorrow with Craig. So I'll tell you about that, Lucy, if that goes any further. We're going to go and suss it out with a few of our tradespeople tomorrow. So yeah, we're actively doing deals. There's opportunities out there. Lucy's backing us up all the time with quotes and lending when we need it. Craig has asked, he says, do you prefer, but actually really lenders, because you're not a lender, are you, Lucy? You're a broker, but do lenders prefer to fund shorter projects, say under 12 months duration, where material and labour costs and also final GDVs are reasonably predictable, compared to longer term projects, for example, in excess of 2 years, where there could be so many more variables? Is there a sort of preference for shorter term loans at the moment?
So I think generally the market sees 12 and 24 months both as the shorter term category. So I don't think you get too much disparity between those two terms. They tend to consider longer term coming into like 5 years. So that tends to be your more dry investment type stock as opposed to bridging and development. And actually, I think what they look to see is how you're managing that risk up front. So when you, for instance, if you look at a development loan, they don't particularly like it if you are pulling together various contractors. So they always want you to have a main contractor, because if you've got a fixed price contract, then somebody is committing to you that is the cost of the contract. And actually then if materials and labour do change, that has to be absorbed by them within the contract. Obviously, there are some more quirks with that variations can be added in, and all sorts of arguments can happen between main developer and contractor. But yeah, all things being equal, if you've got a fixed price contract in place, whether it's 12 or 24 months, it shouldn't make too much difference. I know it has been a little bit more problematic of late where materials have risen quite sharply, no, we haven't really seen that. The only thing that you will find is that because your holding costs are so much more, because you've got 2 years worth of interest and whatever, it then impacts how much you can borrow, because that has to fit within the loan to gross development value. And therefore it kind of impacts your day one loan amount. But in terms of credit appetite, no, it doesn't make much difference.
Okay, makes sense. And just going back to that point about the kind of variations that can come on a fixed price contract, there's a lot of devil in the detail on the development phase of doing projects. It's often overlooked by people offering training in our industry. I don't see anyone offering kind of development style training, which is why we're pleased to hear I'm launching something this year for development, Property Developer 2.0 in Wealth Labs. Look out for it. It's not a blatant pitch, but it is there to help you guys, because there's a huge amount of complexity to tendering a job, getting the QSs involved. As you mentioned there, Lucy, there's often provisional sums for loads of the items. So a fixed price contract isn't often a fixed price contract. And the only way you get those provisional sums down for various items within the contract, the unknowns, is by getting various surveys done, quotes from individual subcontractors like window suppliers, drywall suppliers, whatever it might be. That's an American term, isn't it? But plasterboard suppliers, whatever. Yeah, you know, I've been watching too many American YouTubers doing property, less of the UK ones lately. And so, yeah, I think there is a huge amount of detail in putting that team together around the development side. They call it the REBA stages of work, which is all to do with the architect, various stages of design and construction and tendering and building control regulation level drawing. So there's a huge amount of work on a build that goes before you start actually putting a spade in the ground, so to speak. That's all the stuff that I'm teaching on this new course this year, which there's a huge gap in the market in this knowledge. And, you know, I've seen through my own mentoring, where I've been mentoring clients, the lack of knowledge in the construction phase, because everyone comes off the back of a course having learned about their lease options and their HMOs and their commercial conversions, which is all good knowledge and really, really valuable, obviously needed to figure out what their strategy is going to be. But then they start building, and that's where the problems start, you know. And I've had, you know, numerous clients that have done 1 or 2 builds, and they're on the verge of giving up because it's just going wrong, and developers have gone bust on them. You know, I'm going to teach people about the due diligence of getting people to learn about the builder and what their past projects are, what their pipeline is, all this kind of stuff, and then dovetailing that to the finance. So, you know, being a developer, that's why I want to do these calls with you, Lucy, because teaching people to invest and to develop property. You know, all these things have to dovetail together. You know, you have to know about the construction phase. And actually what people don't realize is you and I, if we're doing a big construction loan together, you'll come down most months on site to meet the bank manager, who comes down every 2 or 3 months. Let's say it's a 12, 18-month build. The bank manager will come down several times for that build and want to see it all. They want to meet the project team. They are smart these days, aren't they? They have, of course, they have a monitoring surveyor as well, don't they? So you guys help facilitate the process, keep the bank happy, make sure the monitoring surveyors are talking to our project managers, our quantity surveyors for the various drawdowns on the development loan. But it's super important how that all dovetails in, isn't it? I don't know.
Absolutely.
Question there, but just to sort of highlight that, have you got any thoughts about how important that is? I guess have you seen horror stories around people haven't done that, or any tips to watch out for?
Yeah, look, I think when it comes to monitoring and things potentially going wrong, what I would say is it doesn't take very long at all for the lender to realise if something hasn't gone to plan. And I've been part of many schemes that have been successful, reasonably successful, or actually in some cases, unfortunately, unsuccessful. And actually, when the problem is spotted, that's not always a big issue. It's more about how you go about dealing with it. So I come back to the point about the customer behind it. Now, what I would say is I do see a lot of people trying to take on projects where they don't have cash in the bank as a reserve. And when you do a development loan, you have a contingency built in, which is normally 5 or 10%, and the lender will insist that you have a contingency. So whatever your build costs are, they will add that contingency in, and that has to be funded, or that has to be built into the facility, just in case you need to draw on it. But actually, what lenders really like to see is actually, do you have a bit more in the bank, or do you have access to capital if you need it? Because
Assets.
things, what's that, sorry?
Or assets as
Or
well.
assets, yeah, because sometimes things go wrong, don't they, Nick? And we've been involved in schemes that have been hugely successful together, but actually we've had some really big unforeseen costs. And even with all of the investigations that are done up front, until you start getting into the ground, you don't always know that that's going to come up and be a problem. And you know, I can think of a scheme where actually, if the customer wasn't in a really good place to be able to plug that gap, that would have been a real challenge. But the bank were relatively relaxed because they were told about it rather than it sort of trying to be swept under the carpet, because that's the worst thing. It's all about communication. If you think that you can try and hide something from a bank and they're monitoring surveyors, then you can think again, because it always comes out the woodwork pretty quick. So it's communication, and it's making sure that you spot the problems, you come up with a plan, and that you engage them before they come to you with it. And one thing that I find really difficult is if I'm ever caught off guard because a customer hasn't told me something, and then the bank calls me up and says, we've been down to site, this has happened, what's going on? And it's very hard to pedal backwards from that. So I would say just being very, very upfront about what's happening is probably one of the biggest keys to success through that monitoring journey.
Yeah, no, really good advice, really good advice. We need to sort of start talking about wrapping up in a moment. If anyone's got any questions, please do raise your hand or post in the chat box or the Q&A box. We've got a couple of boxes I think you can pick on Zoom here, ask questions. So please dive in. If anyone's got anything they want to ask, we can try and answer it for you. I guess just looking to the future then, rates are potentially going up next week. Do you know how much do you think they're going up by? Another 0.25%, do you think? I can't see them going up 0.5% in one hit, can you?
Yeah, I think 1/4 is almost certain. I wouldn't entirely rule out half, but I think 1/4 is pretty likely.
Yeah, a bit scary, isn't it, really? Have to see what happens.
Yeah, I think that will be the trend for the rest of the year, I would say. I don't think we'll start to see that really slow down until the end of the year, beginning of next. No,
sure. Okay. What sort of rates are you seeing on bridge loans at the moment, if you've got a reasonable asset to secure against, and what sort of time scale can you get a bridge loan? If someone's out there and they've got a site they want to buy at auction, bridge loans are obviously a bit quicker. That's one of the benefits of them. They're obviously more expensive. What are you seeing in terms of time and cost for an average bridge loan at the moment?
So I would say for an average bridging loan, you're probably looking at something like 0.9 a month. You can get a little bit cheaper. There are lenders out there with what you'd call market leading rates, but deliverability is not always there. So it just depends on the scheme. I always like to go down the average route, because we're not really a business that likes to just quote headline grabbing rates, because then customers say, well, hang on a minute, you said you could do it at 0.7 a month, yet you're quoting me 0.95. And it's really just a case of looking at the customer, looking at the transaction, and how quickly you need it done. So if you tell me you've got 3 months, I've got a lot more to play with. If you tell me you've got 2 weeks, then I know I need to go to a lender that will pull out all the stops for you. So it can be done in, what's that, sorry?
It might not be the cheapest.
No, exactly, that's it. And really, one thing that I often say to customers is, if this is something which you see as being a really profitable deal, then don't get too hung up on the rate differential, which in the grand scheme of things is nothing compared to you losing the opportunity to buy the property. Obviously, there's limits to that. You have to make sure that it still stacks up, but usually the difference in interest rates between the cheapest and the average bridging rate doesn't really change the dynamics of a deal. And a lot of the time it's a mindset thing, where people just think, oh, I can't pay that, it's not the cheapest, or it looks a bit expensive. But it's all context, isn't it? If you've got a 40% profit margin in a deal, then you can afford to pay a little bit more on the rate to be really comfortable that you've got the certainty. Whereas if you've decided to do one on a much skinnier margin and you're a little bit worried and you're having to control all of the costs, then you're a bit more concerned, and every penny matters. But I think those are the sorts of deals that you have to question whether they're right in the first place, more than whether the funding costs could be cheaper.
Yeah, and you made a point there, which I'd like to big you up, which, you know, because obviously you can't big yourself up in life too much. But what you guys do really well is pick the right deal for the right customer, for the right product, sorry, for the right deal and the right customer, rather than just say pulling off a headline rate. You know, again, I've seen too many clients that have gone and seen a headline rate, gone with the broker, got to the point of evaluation, they've spent for evaluation comes back and goes, oh, you do know the planning is this, or the something is that. And the lender sort of balks at that point, going, well, you didn't tell us that, or we didn't know that. So there's two things there. There's you guys that are extremely experienced and very detailed in what you do, in terms of the upfront knowledge is incredible, and therefore the presentation of the lender is accurate, upfront, well thought out and well presented. You're not just form fillers like a lot of smaller brokers can be. There's that in-depth knowledge of understanding the client and the deal and the pitfalls, and then pairing that with the right lender, regardless of the rate, not completely regardless of the rate, but, you know, not chasing the rate, chasing the right lender, and the rate might be, I don't know, 0.25% out, or 0.5% out, whatever it might be. But the key is making sure you're getting a lender that will do the deal, because you can spend thousands of pounds on messing around and lose deals which could cost you hundreds of thousands of pounds by going to the wrong lender early, just because they happen to have a good rate. You know, they do this, don't they? They suck you in with a good rate, but spit you out the other end if it's not 99.9 points out of 100 in terms of low risk profile, for example. So that rate never really was achievable in the first place. Yeah,
we see that happen all the time, and ultimately it's a balancing act. It's making sure that you get the very best you can, but it's deliverable and within the time scale that the customer needs it. So I would say we're very realistic as a business. We want to make sure we will do the best thing for the customer, and that's our end goal. But at the same time, we won't get into competing on flashy headline rates if we don't think they're achievable.
No. Okay. Well, I think that's a good point to end this month's webinar. Thank you very much, Lucy. I really, really greatly appreciate it. I'm sure everyone that's attended will as well. We'll pop this recording live on wealthlabs.co.uk. So if you haven't already joined that and you're watching this on YouTube or another social media platform, please do subscribe to this and head over to wealthlabs.co.uk, where you can register for free, get loads of free educational content, courses, webinars, pre-recordings, and good stuff to help you get more successful, reduce your risk on your own property investment journeys. I've been Nicholas Wallwork. I am a property mentor. I'm a property developer first and foremost, but I am launching a number of courses this year with Wealth Labs, namely a property strategies course I'll be involved in, a property development course, which I mentioned earlier in this webinar, which is getting into the detail of the construction phase, which not many people have done. I'm launching a book on that this year as well to couple the course. So if you've got a gap in your knowledge around the construction phase, tendering, and pulling together that power team to deliver the construction phase of stuff, watch out for that. And of course, loads of free content at Wealth Labs. Please do us a favor, guys, and shout from the rooftops about Wealth Labs. If you could recommend this webinar recording or Wealth Labs to one of your contacts, would be greatly appreciated. Hopefully you can help someone else on their journey, get a leg up and join a group of lovely people. And I know I can see lots of names in the group that I met on various events already. A lovely community where we're all here to help everyone. So thank you for watching, everyone. Thank you, Lucy. And we will see everyone again soon. Take care.
Thank you. Thanks for having me, Nick.
Cheers for now. See you again.
Take care. Bye. Bye.